Things are getting wild. The repo market is starting to break right as the Japanese bond market melts down, dragging U.S. bond yields soaring alongside. SOFR spreads are ripping to the second highest level in 5 years, and the Fed's emergency credit facility just got tapped for another $25 billion, marking $75 billion over the past 4 days. Is this the early pressure on the yen carry trade or an early stage of a liquidity crisis? SOFR spreads are soaring once again. We have liquidity strain both in the unsecured and the secured side. Here in the U.S., we also have major moves in bonds, both in Japan and in the U.S. A lot to get to today. We're going to start with the standing repo, the Fed's emergency credit facility, when there is a shortage of dollars in the plumbing of the financial system, tapped for another $25 billion today. Now, remember, this is very rare for this to get used. Here, we're looking all the way back to early 2021, and we can see that the standing repo was hardly ever used. So zooming in, of course, over the past 4 days, we have seen an increasingly large, increasingly frequent usage of this emergency credit facility. Again, standing repo, or the SRF, is there when there's a shortage of dollar liquidity in the plumbing of the financial system. The reverse repo is the exact opposite. Now, a lot of people are misunderstanding the point about the reverse repo being empty. The point there is that is not a primary driver of liquidity in and of itself. You have to look at it in the context, in the bigger context. The reverse repo is just a shock absorber that is there for liquidity strain. And the reverse repo being empty, again, in and of itself, does not necessarily matter as a primary driver of liquidity. What it means, however, is that the shock absorber is now gone. And of course, by taking a spread between the reverse repo and the standing repo, when this number is going negative, it means that more money is being tapped from the standing repo than is in the reverse repo, indicating that we have transitioned into a scarce liquidity sort of regime. Of course, the exact opposite of what we have been in the past 4 or 5 years. You have to go all the way back to June of 2020, the last time that spread was this negative. Now, why? The Treasury General account, the government's checking account, has been built up by about $600 billion. Now, the reverse repo was basically empty when that started, meaning that money had to come from bank reserves, which are, of course, the monetary base, or half of the monetary base, the M0. We can see a very strong negative correlation between bank reserves and SOFR spreads. Now, what is a SOFR spread? If you haven't seen the few dozen videos we have done on this very, very briefly, SOFR is the actual cost of capital that is dependent on supply and demand of overnight secured dollar loans. That is what SOFR is telling you. It is now 12 basis points above the Fed's upper bound for the third consecutive day in a row. But as we'll see in a second, it's actually much worse than that. Now, not only that, but the Fed funds rate is ticking higher as well. The Fed funds ticked higher overnight to 3.89. Despite the Fed cuts that we have been seeing over the past couple meetings, Fed funds relative to the reverse repo has actually been ticking higher, as we can see from the purple line or the white line here approaching IORB. Now, if Fed funds goes above IORB, things are getting really bad. Now, I want to point out it is not quarter end. It was a month end, but it has not been quarter end or tax deadline or any of the other excuses that people use to explain and kind of hand wave away these sort of issues with SOFR spreads. It is not quarter end. It was month end, but again, December 1st, as we can see here, $25 billion was tapped from this standing repo. And again, this is the third consecutive day in a row that SOFR has been above the Fed's upper bound. Now, remember, what the reverse repo rate is the Fed trying to set a floor in the price of $1, the most important price in the entire global financial system, which is the price of $1, the interest rate on an overnight dollar loan. The Fed is saying no matter how overabundant dollars get in the plumbing, we will always buy them at 3.75. That is the reverse repo award rate. The upper bound is the exact opposite. That's the Fed saying no matter how scarce dollars get, we will always sell them to you right now at 4%. That is the standing repo interest rate, or the discount window interest rate. Well, the median SOFR has spent 3 consecutive days above that upper bound, above that standing repo and discount window interest rate. And again, the liquidity stress is not evenly distributed. So Here we're looking at SOFR, the secured overnight financing rate. Again, SOFR is dependent on the supply and demand. If you're the only firm on Wall Street with $100 billion, everyone needs cash, liquidity, actual dollars. Well, you get to charge them a very, very high interest rate or price because, of course, you control the small amount of supply. That is the environment that we are currently in. There is more demand for overnight dollar loans than there is supply of actual dollars willing and able to be lent out in the plumbing of the financial system. But yes, 3 consecutive days above the Fed's upper bound, certainly notable for the median SOFR interest rate. That is what we were looking at there, or in the prior chart, that yellow line, that is the median rate at SOFR, the $3.3 trillion SOFR secured overnight funding market. That is the median interest rate. But look at the distribution. The liquidity stress is not evenly distributed. If we look at the 75th percentile, we can see it has been above the Fed's upper bound for the vast majority of the past 30 days. Now, here we're looking at that. We're looking at the 75th percentile SOFR minus the Fed upper bound. Anytime the bar is red, it indicates that 25% of that 3.2 trillion, about $800 billion, is getting financed above the Fed's upper bound. Right now, about 20 basis points above the Fed's upper bound. So firms are paying more money in the SOFR market than they would have to get charged if they just went to the Fed. Now, a lot of stigma is associated with both the discount window and the standing repo, which is why it might not be used. It is also an issue when it comes to a bit of a haircut that gets that you get taken off of your collateral. That's another reason that it does not get used. But remember, the Fed funds is also ticking higher, so the stress is not only in SOFR, which of course is much larger, 3.3 trillion, but the stress is also apparent in the Fed funds market, which is about $80 billion overnight interbank lending market. So liquidity stress in unsecured market and the secured side, and liquidity stress is not evenly distributed. And remember, you have to look at that 75th percentile, 800 billion, which by the way is above the limit for the standing repo facility. As we can see here, there's a limit of $500 billion that can get used from the standing repo. So 25% is getting financed above the upper bound, and that 25% represents $800 billion, which is more than the standing repo could even handle, even if firms were going to the standing repo. So major moves in bonds. Here we're looking at the Japanese 2-year yield up sharply overnight. We also have a major move in their 10-year yield, also up sharply. Rate hike bets are back for the Bank of Japan, and of course, that is sending their stock market sharply lower. Well, remember that the Japanese have been one of the largest creditors to the U.S. They have bought a lot of our debt, both on the sovereign side, the Bank of Japan and foreign exchange reserves, but also private individuals and firms also bought a lot of U.S. debt because remember, you could not really get any yield, any interest in your own country. So a lot of that money went into U.S. Treasuries. So when you get higher interest rates in Japan, whether it be for rate hike expectations, right now, the Bank of Japan, their overnight rate is only at 0.5%. So there's a lot of room to cut once you understand that inflation right now is at 3%. They have negative real rates all across their curve, except for the very, very long end, like the 30 and the 40-year. Those are the only interest rates that are actually above inflation, which is right now 3%. So they still have very accommodative monetary policy with a 3% interest rate. And now the major move overnight or over the past day or so in Japan is more at the short end, which again, the 2-year, that is much more of a central bank sort of story. So if you get higher interest rates in Japan or rate hikes by the central bank, that is going to encourage capital to flow into the yen. Now, remember, a lot of capital went into U.S. Treasury. So what that would entail to transition back into these bonds is a selling of U.S. Treasuries, putting pressure upward on U.S. yields, downward on the bond, and then selling of the dollar to buy the yen to then buy the JGB. And eventually, of course, a lot of buying pressure in these bonds would bring the yield lower. So there's an equilibrium point somewhere. Now, the long end of their yield curve was moving sharply higher, as we can see here over the past month or so. That was more on too easy sort of monetary policy and inflation concerns. But what we see recently is much more a move at the shorter end of the yield curve, which of course is there because of increased bets that the central bank, the Bank of Japan, will hike rates. Well, again, that will strengthen the yen as a currency. That will encourage capital to flow into the yen, which puts upward pressure on the yen or downward pressure on dollar yen, and could cause an unwind of the yen carry trade, which again was you borrow in yen, you sell the yen to buy the dollar to then buy US treasuries or tech stocks or something like that. Well, if you get yen strength because capital is flowing back into Japan because they're hiking interest rates to try to tighten monetary policy, well, that could cause an unwind of the yen carry trade, much like we saw in the summer of 2024. So here's a look kind of cross asset. S&P 500 down by about 0.5% today. I would expect that if this liquidity stress continues, if bond yields continue to move higher all around the world, that will continue. You can see VIX's up slightly on the day. Bitcoin selling off quite sharply overnight in Asia session, and dollar yen, of course, yen strength, dollar weakness. We can see that reflected in the dollar yen exchange rate and DXY dollar index. But look at yields here in America. So remember, if you get yields higher in Japan, that'll encourage capital to flow into JGBs, Japanese government bonds. Well, in order to do that, a lot of that capital is in US Treasuries. So what that means, selling of US Treasury put upward pressure on rates. Now, we also have a bit of a bear steepener going on here in the US due to the fact that it looks like Kevin Hassett is going to be the next Treasury Secretary, the next chairman of the Federal Reserve. So I would expect that bear steepener to continue. He is basically a tool in a number of ways. And so I would expect that bear steepener to continue. I wanted to shout out silver. The past couple days, we have broken out to a new all-time high. And of course, there was some issues with the CME and an apparent cooling issue that no one is really believing. I saw that there are actually triple redundancies when it comes to the CME futures servers. There are triple redundancies when it comes to cooling. So the cooling issue sounds quite bogus the more that I've been able to look into it. But anyways, hopefully that was helpful. There's a lot going on. We'll keep an eye on everything. If anything major develops, of course, we'll put out a new video. But anyways, hopefully that was helpful, and I'll catch you in the next one.